Ron. It's great to have you on Worldwide Exchange and CNBC. You know, stocks has obviously took a huge hit in March. A lot of people got spooked. They probably sold at the wrong time. They may have missed this snapback rally. What's your most basic top line advice to your clients about what to do in the equity market right now?
Well, thank you for having me. I think it's important for investors to have targeted percentages of their liquid assets in the market and allow these targets to dictate their moves. Investors should use this comeback to gauge what their risk tolerances are. If you sold in March or were close to selling in March, or you even thought about selling in March, you probably had too much of your money in the market. You see, we're all built with human emotions, which are contrary to successful investing. Everyone knows you want to buy low and sell high, but investors tend to do the opposite. Instead of allowing these emotions to dictate your moves, you should stick to targets and allow the market moves to determine if you are buying or selling. So, for instance, if you have a sound financial plan that is determined by your risk tolerance, and let's say that calls for you to have 50% of your assets in the market, and the market goes down, and say you're at 45%, you will be forced to buy. And if the market goes up and your allocation goes to, say, 55%, you will be selling. These markets are highly unpredictable. No one knows when we will be allowed out, what the economy will look like when we are back out. So I think it's important to have an asset allocation target and stick to it no matter what you think may or may not happen.
But Ron, do you think that an economy with 36 million unemployed, we don't have any idea what's going to happen? Corporate earnings, they probably mean very little. Companies are withdrawing their guidance. Is that an economy that justifies many equity indexes being just a couple of percent from their all-time highs right now?
Well, I think that proves that you can't predict this, right? If you would have thought at the beginning of the year that the market would only be down this with a pandemic and unemployment, you never would have been able to predict that this would have been able to happen. So I think investors should try not to try to predict this and just stick to a game plan. So that's why I think it's really important that you have a sound financial plan and you stick to that rather than trying to make these predictions because it's so unpredictable.
Yeah, it is. And I guess everybody is trying to play a doctor on TV these days and talk about second waves and, vaccines. But we don't know what's going to happen in the fall, whether we do or do not have some kind of second wave and maybe associated lockdown. Given that there are so many unknowns, is there some easy way to protect your portfolio? Are you buying longer puts? Are you advising clients to buy gold? Some kind of pandemic protection play, if you will, Ron?
Well, there's many different ways to hedge, and, I gauge it based on what their actions were in March. So for clients of mine that were calling me up and wanting to sell, and, I advised them to stick to the plan and, don't let your emotions make these decisions. Now I'm going back to them and saying, okay, we had too much money in the market back then. Let's relook at it, see what we can do to lighten up our allocations, what that does to you on a tax basis. And there are different hedges that you can put on which don't trigger these taxable gains.
Like what? We got about 30 seconds left. What's an easy way for our viewers to do it, Ron?
It's tough for me to say it on a broad market. What everybody is different, and their specific allocations are all different. So it's hard to say to the average viewer, this is what you should do. All I could say is that you should have a financial advisor and go through it with him and help. He can determine what would be the best course of action for you to take.